want to get started here as I know there's a lot of us attending. We don't do a ton of these virtually anymore, but with the attendance here, maybe we should. But my name's Jim Mellon. I'm a certified financial planner. I work with Cantor Wealth. I want to take some time with everybody today to get the focus off of investment strategy. Ultimately, I think it's part of the issue in today's society with too much focus being put onto the investments. There's nothing in your financial plan in terms of the amount of savings or a family's ability to sustain their wealth like tax planning and cash flow planning. And so that's going to be really the focus of today's time. Are investments an important element of everybody's financial plan? Well, of course. But ultimately, if you reached for the remote control and turned on your favorite financial news, and the feedback was to go out and buy a low-cost, tax-efficient, globally diversified index fund, and you turned on that same channel the next day and got the same feedback, I think that the networks have figured out that people would stop watching. And so, ultimately it's, hey, buy these top 10 stocks and avoid these dogs. And, let's make sure that we're being active in our portfolios. And it's really contributing to a lot of worry and ultimately, again, this real issue in our society about putting the microscope over the investments. And so today, what I'd like to do is raise that magnifying glass away from that investment page and really focus on everybody who's attending this webinar's first homework assignment, which is number one, to get a cash flow plan built. What's coming in, what's going out on a year-over-year basis, factoring in market risk, taxes, longevity, and inflation. As I mentioned, my name's Jim Mellon. We're all pleased to have you here. We're going to be nice and tidy in terms of our timing. And so we're going to get everybody out of here by 1 o'clock. There is a chat function. If you do have questions, I will try to get to everybody's questions, certainly at the end of our time. I might have mentioned that, I'm a certified financial planner. I think that's really important. In today's day and age, there's a lot of arbitrary titles out there. And, I think for everybody attending here, the floor for the, amount of expertise that you should be looking for in terms of anybody giving you financial advice really should be that certified financial planning designation. It is the highest level of education you can get in my field. And, I'm pleased to say that I've been doing this for over 10 years now. And, again, when I first started out, it was investments. And as I've seasoned in my career, I've really sort of taken a step away from that and focused more on cash flows and taxes. And so that's where we're going to spend our time today. So without further ado, let's dig on in. While I'm getting the webinar started here, these are conceptual, right? And so, the examples that I'm going to provide to everybody today, it is the concepts that I'm trying to dig home for everybody. And so not everybody is going to be in my hypothetical cash flow plan here. Not everybody's 50 years old that are joining us. Not everybody is in the same, level of income or net worth. But, my hope today is to drive home the concept of planning, because again, there's nothing like planning that's going to help your family in terms of sustaining your level of wealth and building it efficiently. And so let's start with how I think about it first, right? As I mentioned, there's really 4 risks that are associated with everybody's financial plan. Number 1 is market risk, which I've just discussed. I think everybody understands that we've got to learn how to navigate through the stock market, the bond market, the real estate market, really any capital market. And then number 2, we always want to plan for longevity. Okay, we never want to have, we want to have our money outlive us. A bit of a tongue twister there. And then 3 and 4, we're really going to spend time on. Taxes are going to be your biggest single expense over the course of your lifetime. And so figuring out how you can lower your lifetime effective tax rate is really going to be central to our discussion today. And then number 4, of course, inflation. Hot button topic. You know, I teach a lot of classes. I volunteer for a lot of different organizations, including you know, high schools and foster care initiatives to help, you know, improve financial wellness in our society. And inflation was sort of sneezed at, you know, a few years ago, and now these days, inflation being where it's at is certainly top of mind for everybody. So market risk, longevity, taxes, and inflation are really where you should start with your mindset. And then the first homework assignment for everybody is cash flow planning. So what's coming in, what's going out on a year-over-year basis, factoring in these risks. And so our axes are, you know, how much liquid dollars we have, and then of course time. I'm always planning out, as I finally call the end of retirement or the end of the line, I'm always planning until 95. Let's start our journey at 50, and then let's go with 65 here for when we begin retirement, and let's put 72 also on our timeline. And so, you know, first thing is tracking expenses, you know, income and expenses, which one has a greater weight in terms of planning? Both are important, but I start with expenses. You know, if we spend $5 a month, we can all sort of sail into the sunset right away, but we don't. So we need to figure out how much we're spending and on what, because different costs are going to be tied to different rates of inflation. And so let's just start with simple, easy examples today. So first is our living expenses. So our living expenses in our, you know, year 50 here for our hypothetical family, let's just say that we're spending $60,000 a year on living expenses. In 15 years, that time between age 50 and 65, that turns into $100,000. Okay, and so that's just using 3.5% for inflation. Inflation, you know, at 3.5% is really close to that 100-year average for inflation. So I'm still comfortable using that in my financial plan for general costs of goods. That same $60,000 cost at age 50, at age 72 turns into $130,000. Quick, easy rule of thumb here, if you're using 3.5% for inflation, you can double whatever cost that you're trying to inflate. And so in my example, age 50 here, at age 70, that same $60,000 cost turns into $120,000. So those are our living expenses. And then, of course, we've got our mortgage, right? Our mortgage, you know, there's lots of different types of mortgages out there, but let's just use a fixed mortgage for 30 years. And so let's just say that our mortgage is $25,000 at age 50. It will not inflate because, again, it's a fixed interest rate. And so that same cost is going to be experienced in our hypothetical family at age 65. And then by the time our family gets to 72, that mortgage gets paid off. Amen. And so ultimately, we total these up, right? And so we've got $85,000 of expenses today. That equates to $125,000 of expenses at age 65, 15 years later. And then that same cost that was once $85,000 at age 72 has now turned into $130,000 because our mortgage has dropped off. And so this is sort of the beautiful thing about cash flow planning is you can predict sort of where your expenses are going to lie with a reasonable probability of success. And so first task is to get your expenses inflated out to whatever date you would like. And this works for people that are thinking about retirement. I would say the vast majority of my clients are, you know, entering retirement or already retired and are really looking for ways to produce tax efficient retirement income. And so let's go back into income now on the ledger. And so our next responsibility is to estimate our future fixed income sources. And so for income, let's say that we start at age 65 with a pension. Okay, our pension
at age 65 for this hypothetical family is going to be $60,000. And there's no Social Security for our hypothetical family here. And so ultimately they have this shortfall that year or need of $65,000 plus taxes. Okay. And so, when we look at our cash flow plan as we get to age 72, well, now all of a sudden we are going to have Social Security. And so, between you and yourself, and I'm going to use a married family here, or two individuals in the household. And so that pension, and the reason why I illustrate this is for those of you that still do have pensions, figuring out if that has a cost of living adjustment is going to be really important. And so in my example, this family does not have a cost of living adjustment. That $60,000 at age 65 is going to be $60,000 at age 72. And then there's Social Security that comes in for both of them. Social Security, there's a lot of planning when it comes to Social Security. And so do you take your Social Security as early as you can at 62, or do you delay until age 70? And keeping in mind that after your full retirement age, which is based on your year of birth, after that full retirement age, each year that you delay, it's an 8% guaranteed increase, which is a great deal. And so in our hypothetical example, between myself and my wife, we get $50,000 of Social Security. So we have $110,000 of future fixed income the year we turn 72. And so ultimately that $110,000, the $60,000 of a pension, the $50,000 of Social Security, that offsets our $130,000 cost. And so the year that we turn 72, we now have $20,000 of a need. And so how do we know if we're on track for retirement? And so, goodness, at 65, I need $65,000 each year for the rest of my life. And I need that to last me. And I need that not only to last me, but I also need it to navigate through the stock market. I need it to take into account taxes and inflation as well. And so at what level of liquid net worth would I have to be at if I needed $65,000 a year for the rest of my life? And what we do in academia is we divide that shortfall, that $65,000 need, by what we call a sustainable distribution rate. And I'm going to do my very best in this webinar to stay away from industry slang. I find it to be extremely unbecoming. And so, what that means in English is how much can I take from my liquid investments without running out of money before I get to age 95? And so when I divide 65,000 into 4%, which is what I would use at 65, I get $1.6 million. And so I used 4%. Based upon the age of this hypothetical family. If you retire earlier at 50 or 55, well, now you have a longer time period in front of you to plan on. And, goodness, I know some of us are saying, 95, I'm definitely not going to make it. I went to see my grandmother in New York for Thanksgiving. She takes a little pill and, that has, thinned her blood. And so now she, is still beating me in gin, I'm happy to report. She cheats a little bit, but I do let her get away with it. But ultimately, we're living longer, stronger, healthier lives these days based upon diets and the way that the medical field is advancing. And so planning to 95, I think, is a prudent practice. And so if you're retiring earlier, that 4% maybe should turn into a 3 or a 3.5% sustainable distribution percentage. And if you're retiring later, well, as you age, and this is also the beauty of proper cash flow planning, a lot of us underlive our retirement because we're afraid of running out of money. And so how much can I spend each and every year without running out of money? As you age, you should be able to take more from your liquid investments. So that sustainable distribution rate should grow over time. The plot thickens with my hypothetical family, however, because I don't need $65,000 a year for the rest of my life. At 72, I found out, based upon the work that I've done, I only need $20,000 that year. And so $20,000, to keep it simple, into 4% means that, my retirement number is $500,000. So for this family, I need between 1.6 million and 500,000 in order to retire on time at 65. And so, this work is really the beginning of how we can start to discover what type of tax strategy makes sense for us. And so, when we think about, well, goodness, well, if I'm at $400,000 of liquid net worth, for example, well, how do I get to that $1.6 million? And, a lazy sort of approach might be to say, well, all you need to factor in is your growth rate. And that growth rate to get from 400,000 in my example to 1.6 million is really high. That growth rate is around 9%. And so, to take that amount of risk to achieve that 9% rate of return is really it's an aggressive rate of return to try to achieve. And so your jobs as your own financial planners, as mine is to lower the amount of risk that you have to take to achieve your goals. And ultimately spending less in taxes over the course of your lifetime can lower that growth rate. And so let me expand on that. To get that growth rate lower, let's focus on a savings strategy leading up to retirement, and then a distribution strategy when we're retired. And so how are we saving? How are we accumulating? And so for a lot of us, that's pretty simple, right? I'm going to lace up my boots. I'm going to go to work. I'm going to keep my head down, and I'm going to save. And so a lot of us have said, well, goodness, I'm just going to save in my pre-tax retirement plan. And so we've sort of been tricked. A lot of us think that our, expenses and income, and as a result, our taxes are going to be lower in the future. And so as a result, if your taxes are lower in the future, why would we pay taxes on our retirement dollars today? And so a lot of us have saved pre-tax. This cash flow planning can shine a light on how we should be saving. It is a definition of taxes. Where are my tax rates today relative to my tax rates when I need the money? If I'm in a higher tax bracket, as I mentioned, today relative to when I need the money, I would say pre-tax. If I'm in a lower or the same tax bracket, then I would want to save post-tax, because ultimately I want to take away as much legislative risk off the table as I possibly can. And when I think about national debt, what's already in legislation, stimulus packages, and I, sort of see where the puck is going, somebody's going to have to pay for all this. And so I think, beyond what's in legislation today, I think taxes are going to go up, and that certainly would be supported by what we've found historically. Back in the 80s, the top marginal tax rates were somewhere in the ballpark of 80%. We look at the top marginal tax rate today, and that tax rate is under 40 at 37%. So how am I saving? Am I saving pre-tax? Am I saving post-tax, after taxes in my Roth, in my tax-free pool of money? Or am I saving in my taxable account? Am I saving in my trust, my joint account, my individual account that I'm sure has a transfer on death beneficiary designation attached to it? How do I save relative to, goodness, how am I going to pay myself back in the future? And so if you can save efficiently from a tax perspective, well, that means that your growth rate is actually going to be less. And also, savings on the way up should also equate to a savings rate as well, right? So am I saving $5,000, $10,000, $20,000, $100,000 a year? How much am I saving along the way? In this hypothetical example, if I save just $15,000 a year, well, now my growth rate drops from 9% to about 6.25%. And that's not factoring in the tax savings that I'm going to bring all together for us today. And so how do we lower the amount of risk we have to take in the market? Well, legally, of course, but we want to keep as much away from Uncle Sam as possible. We've all been good enough citizens. And so how do we navigate through that tax code? Let's expand on it. And so this savings strategy. So we have three different ways that we can save money. And we also have three different pools of funds that we can pay ourselves back from. And the purpose of this is to get more flexibility and more control over how our income is being saved and ultimately how our income is being generated when we retire. And so let's sort of define these. So the first pool is a tax-free pool. The second pool is a taxable pool. And then we have our tax-deferred pool of money. And so up here at tax-free, these accounts are generally going to begin with Roth. Roth IRA, Roth 401k, Roth 403b, there's Roth TSPs, employer-sponsored Roths. And then here in our taxable pool, this is where the bank account is. This is where our real estate is, and a little out of the purview of today's time, but ultimately real estate is going to be the biggest investment a lot of us make. And so, goodness, if we have rental property, what's our capitalization rate for that rental property, our return on equity, our cash on cash return? All of those statistics you really should have like the back of your hand. And then ultimately, if you want to sell real estate, well, goodness, I've been writing off a certain amount of depreciation over the course of the time that I've owned the property. That all gets recaptured when I sell it. And so, am I prepared for that big tax bill? And then what other strategies have I executed along the way in terms of my other, outside assets in this pool of money for portfolio management that can offset some of those capital gains? Your primary residence is, if you live in your primary residence for 2 of the last 5 years, you get up to $500,000 off of your capital gains. So it's tax-free. If you're a single tax filer, it's $250,000 of your capital gains, which is tax-free from the government. And so lots of great strategies out of your real estate, a little out of the purview of today's time, but I did want to just mention it. And then, of course, this is where your trust account is. This is where your individual accounts are with the transfer on debt designation, joint accounts, really any stock, bond, mutual fund, exchange traded fund that's outside the shell of a retirement account. That's where those investments are located in your taxable pool. And then over here with our tax deferred pool of money, this is a traditional IRA. This is where your 401ks are that are pre-tax, 403bs if you're working with a nonprofit. This is where your TSP is, or your 457b if you're a government employee, SEP IRAs if you're self-employed, solo Ks, lots and lots and lots of different accounts here. And then, while not traditional types of accounts, Social Security and your pensions are also located in this pool of money. And so let's kind of go through each one here and figure out how we get money in to each pool and what the contribution limits are. And so first, with our tax-free pool, it is after-tax contribution. So I pay taxes on my income. I've already paid taxes. Then I contribute to this pool of money, and it grows on a tax-deferred basis, meaning gains and losses don't matter in this pool. They also don't matter in your tax-deferred pool. Only contribution and distribution matters in these two pools. Gains and losses do matter in your taxable pool. It's after-tax contributions into your tax-free pool that grow on a tax-deferred basis. And when they're distributed to you, it is 0% state and federal. And so it's a very powerful, very tax-efficient pool of money. Roth IRAs, Roth IRAs have a contribution limit if you're under 60 of $6,000. If you're over 50, it is $7,000. And if you're under 50, it's $6,000. And that will go up to $6,500 next year. And then your 401ks this year, if you're under 50, it's $20,500 that you can contribute. and then you get a $6,500 catch up if you're over 50. There are income limitations to a Roth IRA. So if you make too much money, then you're not able to contribute to those accounts. There is a backdoor way that you can contribute to a Roth. So if you are over those income thresholds for married couples, it's over 230,000 of modified adjusted gross income. You can take money from your bank account, contribute it to a traditional IRA, and then do a conversion up to your Roth IRA to get money in. It's called the backdoor Roth contribution. It's a relatively detailed strategy, so make sure you do your diligence on whether it's in your best interest. And with Roth 401ks and 403bs, there are no income thresholds. You can make $10 million a year and still contribute to your employer-sponsored Roth accounts. Okay, over here in your taxable pool, it is after-tax contributions. Just think about going to work each and every day, and upon distribution, we pay capital gains taxes, with the exception of the bank, which produces interest, which is taxed at ordinary income. We pay capital gains on this money, and short-term capital gains are just what's pictured here. Right below, I have our wonderful ordinary income tax rates for this year. I'm picturing married filing jointly. Short-term capital gains, if I've held the investment for under a year, I'm going to be charged ordinary income on that gain. If I've held the investment for under a year, I'm going to be, or excuse me, for over a year, I'm going to be charged long-term capital gains, and long-term capital gains are charged at a much more favorable rate. Generally speaking, it depends on income. Most of us are going to pay 15%, but that income threshold is an important one because you can pay no money on your capital gains all the way up to 23.8%, depending on your income. There's a lot of great strategies out of this pool that I'm going to come back to in a moment, like tax loss harvesting. But for now, let's move on to our tax deferred pool of money. So this is pre-tax contributions, meaning I have not paid income tax on this money, and it gets into this pool, and upon distribution, I'm paying ordinary income on that money, the highest of all the tax treatments of all of these pools. And, you know, ultimately, we've got a partner in this account, okay? And that partner is taking a slice of whatever's in this pool. And that partner's not a very fun one, the IRS. And so let's just kind of think about it. So it's not just that the IRS gets a portion of the ultimate value of this pool, but the IRS is also going to take a portion of the future growth in this pool of money. And so, you know, when you say, oh goodness, I had a 8 or a 10% investment rate of return, well, you have to factor in taxes because, you know, the IRS is going to take a portion of that growth eventually. And, you know, the IRS works against us in a couple of ways here. Number one is required minimum distributions. So required minimum distributions begin at age 72. And they, you know, the IRS requires that you take out 4% of the value of this pool of money. And so if I have, you know, $1.5 million here, well, I would need to take out $60,000 each year. And actually, it's more than that because as you age, the IRS demands that this percentage goes up each year because they have not gotten their hands on their tax dollars yet. And so you're forced to take this money out each and every year. The IRS works against this again in terms of income and respect of the decedent. And so, you know, let's kind of just think through this. So what I've pictured below here is married filing jointly income thresholds at $20,550. For the 24% bracket, it's $340,100. And so those are that 24% is our marginal tax bracket, and that 340,100 is the income threshold at the top of the 24% tax bracket. Just a quick refresher, each dollar is treated differently in our tax system, and so it is a marginal tax system. So if I make, $150,000 a year, my top marginal bracket would be in the 22% bracket, but each dollar being treated differently, my effective tax rate would be a blend of the 10% bracket, the 12% bracket, and whatever income is left at that 22% bracket. That's your effective tax rate. And the purpose of today's time is to lower your lifetime effective tax rate. And so to bring it all back together, these are married filing jointly income thresholds. And so, my lovely wife, Mary, we are, goodness, we're expecting our first child anytime soon, anytime here. She's due on the 25th, but one of us almost 100% of the time is going to die before the other. And so if I'm to pass away and then I provide that $1.5 million traditional IRA to my wonderful wife, Mary, well, she still is going to be subject to required minimum distributions. She also is going to be subject to single tax filing rates. And so these income threshold, this 20,000, this 83, this 178, this 340, go ahead and chop them in half to get a representation of single tax rates. The plot continues to thicken. So Mary passes away now, and we pass our traditional IRA over to our children. With the Secure Act, our children now have 10 years to deplete that account and ultimately pay the taxes. It's, gone are the days where you can take a check each year for the rest of your life, a small check, and pay the taxes as you go. Within 10 years, the kids will have to pay 100% of the taxes and whatever's left over. And so we contrast that against our tax-free pool of money. So in our tax-free pool of money, I pass away, I leave $1.5 million to Mary. She has no required minimum distributions and no tax consequences based upon her becoming a single tax filer. And when she passes away and we pass those assets to our children, ultimately they do have required minimum distributions. The account still has to be depleted within 10 years, but there are no tax consequences to those distributions. And so I have a lot of clients that have wonderfully successful children, and based upon our planning, we figured out that the parents are actually in lower tax rates relative to where the kids will be. And so what we are doing is we are lowering the value of this ticking tax time bomb. A lot of us have a very large tax deferred pool because we've been told and we've always thought that ultimately we're going to have lower tax brackets in the future relative to when we were working. And to be fair to everybody, Roth accounts didn't come along until long after pre-tax accounts came along, but we've all sort of been ingrained in this thought that our expenses and income, and as a result, our taxes are going to be lower in the future. And so let's stress that. But to get back to my point, we figured out through cash flow planning that our parents or my clients are at lower incomes than where the kids will be in the future. And so what we're doing is we are executing what we call a Roth conversion. I'm taking money from this pool, I'm moving that money into my Roth IRA, and I'm paying the taxes. I think it's really important to understand here that somebody is going to pay the taxes in this tax deferred pool of money, whether it's you, your spouse, or your kids, or your ultimate beneficiaries. Somebody has to pay the taxes. And so how do we lower that lifetime effective tax rate? How do we get more flexibility and control? A lot of that planning has to do with Roth conversions. And so let's take a hypothetical example. And let's go back up to my family here. And so required minimum distributions come along at age 72. And so at age 72, I have a $60,000 pension. Social Security is only going to be taxed at, and it does depend on income, but for most of us on this call, it's going to be taxed at 85% of your, 85% of your Social Security benefit is going to be taxed at your ordinary income tax rates. And so that $50,000 of Social Security here, $40,000 of that is going to show up on my tax return. And so fixed income in my hypothetical example, just falling out of bed in that year, gross income, I have $100,000. Okay. Now let's assume that in my tax deferred pool, I have $1.5 million here. And so that equates to a required minimum distribution of $60,000 because it is 4% of this $1.5 million. And so let's bring this example down to our tax table. And remember, the reason why we lead with cash flow planning is because your cash flow planning is going to shine a lot of light on your tax strategy. Once you have your cash flow plan built and your tax strategy is being executed, you've ultimately lowered the amount of expenses over the course of your lifetime. And so that means now your investment strategy can come into play and you can target a lower rate of return relative to having no tax strategy or no cash flow plan built. And so let's take this example where I have a $60,000 pension. I have $40,000 of taxable Social Security, and I have a $1.5 million tax deferred pool. I have $1.5 million in my tax deferred pool of money in my traditional IRA. And so let's, kind of making up some numbers here. Let's say that when I'm working, my taxable income is $150,000. And so quick refresher here, we have gross income, then we have adjustments to that income, above the line deductions, and then we get our standard deduction here, okay? And our standard deduction is essentially, we can either itemize if we can come up with more deductions than what the government gives us with our standard deduction, or we take that standard deduction, which wipes off a certain amount of income from our adjusted gross income, and then we get to what the government gives us the bill on, which is what's known as taxable income. And so let's just say that when I'm working, my taxable income is $150,000. Well, if my taxable income is $150,000, that would put me very clearly between the $83,000 threshold and the $178,000 threshold. And so when I'm working, I'm in the 22% federal tax bracket. Let's now take when I'm retired, okay? And so let's use blue for that. And so when I'm retired, I had that $60,000 pension. I have my Social Security, which is going to be $40,000. And then I have my required minimum distribution, which is based on 4% of the value of this pool, which we've said is $1.5 million. And so my required minimum distribution is going to be $60,000 here. And so my total gross income in the year I turn 72 in this example is going to be $160,000. Let's say I take my standard deduction of, let's just say it's $30,000 to keep it easy, which gets us to taxable income, which is going to equate to $130,000. So my taxable income when I'm 50 in my hypothetical example was $150,000. So when I'm 50, my tax rate was 22% for my top marginal tax. And when I'm 72, my top marginal tax rate is also 22%. And so I find that I've been sort of fooled. I find that when I calculate my fixed income in the future and I calculate my required minimum distribution in the future, I'm in the same tax bracket as I was when I was working. And that's going to be the experience for a lot of us. A lot of my clients actually find that they're in higher tax brackets because they've been high earners and great savers. And so the plot is going to thicken here because what's in legislation is that the Tax Cuts and Jobs Act is going to sunset at the end of 2025. And so in 2026, what's in legislation is that ultimately this 10% threshold is going to turn into the 12% marginal bracket. This 12% marginal bracket is going to be the 15. The 22% marginal bracket is going to be the 25. The 24 is going to be the 28. The 32 will turn to the 33. And for those of you that are high income earners and are going to have high income in the future, they're going to do away with the 35 and the 37% marginal brackets, married filing jointly, and they're going to make that 39.6%. So ultimately, taxes are going up in the future. That's in legislation. And so back to my hypothetical example, I'm actually not going to be in the 22% federal bracket. I'm actually going to be in the 25% federal bracket in the future. And so what that tells me is that a Roth conversion would make sense. And so, if my taxable income was 150K, well, I've got $20,000 of room in this bracket that I could do a Roth conversion with and just fill that bracket up at 22% while I was working. And that's the goal is, how do I get money out of this pool early and at a more favorable rate? And if you do this right, your break even is day one, because all the future growth in this wonderful pool of money is 100% yours. It's 100% your spouses or your partners. It's 100% your kids. All the future growth in this pool, part of that is going to be the IRS. It's a fragile pool of money filled with a lot of ways that you can sort of get tripped up and overpay in taxes. And, goodness, if I pass away, well, now all of a sudden my spouse or my partner is going to be at a single tax rate. And that means a further erosion of your hard-earned savings. And then, goodness, I give the money to my kids, and ultimately they have to pay the taxes at their income rates. And, if my kids are successful, they're going to be in their peak earning years or close to it. And so now I've jeopardized them from a tax perspective. And then, goodness, I think about where national debt is. I think about progressive policies, and I think about, stimulus packages and, all of the different elements to our society that we are going to actually have to pay for. And I think with a reasonable probability that what's in legislation is actually going to pale to what's going to occur over the next 10 years in terms of marginal tax brackets going up and the income thresholds associated with those marginal brackets to actually go down. And so back to my hypothetical example, well, if I've determined based on the work that I've done with my cash flow plan that I'm actually going to be in the 25% bracket long term, even if I did a conversion into the 24% bracket, each dollar is treated differently, as I mentioned. And so just because I bleed into the 24% federal bracket, well, goodness, that does not mean that 100% of my income is now taxed at 24%. Only the amount of money that's in that bracket will be treated at that 24% federal tax rate. And so ultimately paying 24% versus 25% is a great deal on your retirement savings. And then you annualize that savings over a 30, 40, 50-year period. And that savings can be substantial when you think about your time horizon for your kids or your ultimate beneficiaries. And so conversion planning is a detailed process. If you're planning on moving to a different state, now all of a sudden state income tax rates start coming into play. and you really need to navigate through, well, goodness, am I overpaying California? I actually have a few clients that are moving from California to Texas. It's where they're from. And so, we're holding off on conversions until they retire and move to that lower income tax state. Even with legislation where it is, with income taxes going up, it still doesn't mean that we're going to overpay with California income tax, which is a substantial tax rate. Okay, so I've said a lot there with planning around our tax deferred pool. Just very briefly, I do want to go into tax loss harvesting. And so tax loss harvesting is only available out of this pool of money. And that's because gains and losses matter in that pool of money. And so, when we think about, okay, here's 2020, for example, markets go up and then markets go down and then markets go up, for you engineers in here, this is of course to scale. We had a positive investment rate of return that year. And I just want to pause briefly to say that, I had family and friends affected by COVID, and I know a lot of us did here on this webinar. And so, I want to be sensitive to that. But we're, taking a financial, webinar here. And so how can we navigate through down markets and make them as efficient as possible? And for our families. And so if I have investment A, and again, this is only available out of our taxable pool. If I have investment A, a U.S. Stock position, I use low cost, tax efficient, globally diversified funds. Okay, it's a U.S. stock fund. Well, we all know that, U.S. stock went down that month of March, down 35%. What our team did was we didn't know where this bottom was going to be. And so we sold all the way down. So we sold investment A and we bought investment B, also a U.S. stock fund. What we did to avoid the wash sale rule, importantly, is, let's say this is a Vanguard U.S. stock fund. Well, what we did was we just changed it to a Charles Schwab or an iShares U.S. stock fund. And so we changed the fund family, but I needed U.S. stock exposure in my portfolio. I got that from, in my hypothetical example, I got that from Vanguard at the time. I sold that Vanguard position in my trust account, and I bought the same second an iShares or a Charles Schwab U.S. stock fund. I'm never prognosticating. I'm never in cash. I'm never paying for clarity. I don't know where the bottom of the market is going to be. And so as a result, I always want to be participating in the market. And so we really have two choices. We can either ride the wave down and just have investment A get back up to here. And we'd recommend that if you're uncomfortable with this approach. Or you can have investment B get here for you and dock this loss on your tax return. These capital losses go forward on your tax return indefinitely until you use them. You can take $3,000 off of your ordinary income tax each and every year. And so if you're in the 24% federal tax bracket, for example, that's an $800 to $900 break on your overall tax payment, which is wonderful. And then, again, the purpose of this whole thing is, how am I generating this $65,000? How am I generating this $20,000 each and every year? I want to pull some of that money from my tax-free account. I want to pull some of that money from my tax-deferred account. I want to pull some of that money from my taxable assets, because the way that I generate my income in retirement is ultimately going to lower my lifetime effective tax rate. And so a lot of us are going to wait for Social Security to mature. And, as a result, we're going to need to start spending down our assets. And ultimately, a lot of us are going to make a decision that we're going to sell investments from this pool of money. And so getting greater tax efficiency by having gains and losses offset each other is a wonderful way to build in more tax efficiency into your plan. And so how am I generating the income each and every year? That's what's going to differentiate each family from the amount of taxes that they pay. And so let's see if we can crystallize it here on our, see how I'm doing on time. I've got 10 minutes left. And so let's see if I can crystallize it here. We've got two families, really, simple, basic examples. We've got Bob and Bonnie here. They've got $1 million in their tax deferred pool of money. We've got Jake and Joni who have done some planning. You've got $500,000 in your tax deferred pool, $300,000 in your tax-free pool, and $200,000 in your taxable pool of money. They each have $1 million. They each need $100,000, and everybody's 72. And so just to keep it easy, I've said that each one of these families has a pension for $50,000. Because they're age 72, they have required minimum distributions. And so those required minimum distributions are going to be a byproduct of the amount of money that you have in your tax deferred pool. And so Bob and Bonnie have $1 million there. And as a result, they need to take out 4% from that pool of money. And so that's $40,000. Jake and Joni only have $500,000 in that pool at this stage of their life because they've done some planning. And so their required minimum distribution is only $20,000. Bob and Bonnie don't have any flexibility. They don't have any control over the way they're distributing their income. They don't have any diversification over the way that they're generating their income. So they're forced to take more money out of that retirement account. And ultimately, that's how they satisfy their $100,000. So their gross income, as a result, is $100,000. Now, when we look at Jake and Joni, they do have diversification. They do have different pools of money that they can generate that same income. And ultimately, the purpose of this is on your tax. When it comes to taxes, is Jake and Joni are able to draw a line in the sand here and say, you know what, I know I have this fixed income, but beyond my fixed income, beyond my pension, and beyond my required minimum distribution, I'm going to draw that line in the sand each and every year because I know I'm going to have to fill these brackets up, but I want to live in higher tax brackets, but I want to pay lower taxes. And that's really what we're trying to get across with our time today is, how do I live in higher tax brackets, but only pay in lower tax brackets? And so Jake and Joni have accomplished that with proper planning, proper savings, proper tax strategy through conversions. And so they can do tax loss harvesting, which means, tax loss harvesting means that they've harvested losses over the course of their lifetime. They've kept themselves invested during tough times. So they've still had positive investment returns like our clients did in 2020. And ultimately, they're able to offset gains and losses out of their taxable account to actually pay no money in capital gains taxes. And so they're able to generate another $20,000 through tax loss harvesting out of their taxable pool. And then to round it all out, they're going to generate another $10,000 from their tax-free pool. And so that gets them to their $100,000 of a need. I'm just going to itemize exactly what is ordinary income here. Pensions are ordinary income. Required minimum distributions, ordinary income. Tax deferred income, money from your traditional IRAs or 401ks, that's all going to be ordinary income, which is why the gross income here for Bob and Bonnie is $100,000. The gross income for Jake and Joni is actually $70,000 because tax loss harvesting, gains and losses offsetting each other. There's no taxes due there. An income generated from a Roth IRA has no taxes associated with it. So Jake and Joni actually start at a lower gross income threshold. Now let's take our standard deduction. Let's say we take $25,000 of a standard deduction, which gets us to our wonderful taxable income. For Bob and Bonnie, that taxable income is going to be $75,000. $25,000. For Jake and Joni, they have a standard deduction of $25,000, just like Bob and Bonnie, which means their taxable income is going to equate to $45,000. Total tax due here for each family, roughly $8,000 federal for Bob and Bonnie, roughly $5,000 due here for Jake and Joni. You know, I'm in a pretty good mood today, so let's take a vacation. But then we can substitute this next portion with healthcare costs or a new car or whatever it is we have in terms of an expense in any given year. But Bob and Bonnie don't have any flexibility. They don't have any control. And so let's say they want to take their family members on a wonderful cruise, for example. Let's just say that the vacation is another $25,000. Well, if that vacation is going to cost $25,000, they don't have anywhere to pull that expense from other than ordinary income generating pools of money. And so that's going to drive their tax cost up to $14,000 in that year. They are not able to draw that line in the sand and say, hey, I know I'm going to be at a certain income threshold with fixed income, but I want to take my family on a vacation. Well, Jake and Joni can take their family on a vacation by just distributing income out of their Roth IRA. And so now the tax cost is not $3,000, but now the tax cost differential is $9,000 in that year. And we're just discussing federal income tax. And so again, it really starts with your ability to get your cash flow plan built. What's coming in, what's going out on a year-over-year basis. From there, you're able to delineate what type of tax strategy makes sense for you. And ultimately, if you can save yourself 15 or 20% in taxes, hey, I saved at 25% when I was working for my federal tax bracket. And so I saved pre-tax during that time. And then I got money out through a Roth conversion at 12%. Well, there's no investment strategy on earth that can compete with your ability to plan for taxes, which again are going to be your biggest line item in terms of an expense over the course of your lifetime.